Like an FHA loan, you've got to have particular ratios to be able to qualify.
Or in an FHA, they'll be a little bit more forgiving and they'll let you go up to 55%.
55?
55% of your gross income.
55? Are you tired of renting and burning through your money? Tired of living with your family or couch surfing? Well, I've got some easy tips to help you get into the American dream of homeownership. I've got Eddy Foster with me. He is with Lone Star Mortgage, and we've got the do's and don'ts and the easy tips to get you a mortgage.
Absolutely. First thing that we want to do when you are starting a home buying process is you want to make sure that you have a correct budget. One of the things that you're going to want to do is you're going to want to know what is going in and what is going out. So you're going to want to sit down with a pad and a paper, and we can help you out with that. We can send you an Excel spreadsheet that'll help you get along with that. And you're going to want to know exactly what your minimum payments are, what your gross income is, and then you're going to want to take that and back that out of all of your monthly debt that you currently have. Whatever is left over from that is a portion that we're going to use to qualify you. And we'll get into those numbers in a little bit.
About cash and assets. So down payments can range anywhere from 0% to a grant, 2 to 3%, 5%, 20%, up to about 30 to 35%, depending on the condition of the house, loan to value, and if you're a veteran. So
Correct.
Those are some of the things that you really want to look at. A lot of our clients find assets. Their family gives them money for their down payment, or they're able to take cash out of their 401k, or they have been saving. They've got some mattress money set aside for a down payment.
That is correct. Now, when she says mattress money, you want to be careful. We don't want you to actually have money sitting underneath your mattress and then go deposit all that money into the bank. That's going to create a problem. So, but if you do have money that's sitting aside in cash in a safe or a safety deposit box, before you make any deposits, make sure you talk to your loan officer. There's a right way and a wrong way to do that. So let's make sure that you guys get that experienced loan officer on your side to educate you on that process. As far as the mortgage is concerned and the down payments, different programs, that is also going to depend on a number of different factors. Number one is going to be, like Hannah said, are you a veteran? Are you not? What is your credit score? We have to look at your credit score. What is your debt to income? Meaning, how much money do you make versus how much is going out? Every program is different on what they allow you to spend on a house payment. Now, with that being said, something that we're going to want to cover during that process is not only what you qualify for, but what are you comfortable with? Those are two different things that we're going to want to cover, because just because I say you qualify for a $5,000 a month house payment may not be what you're comfortable in paying. So we need to have those discussions and talk about all those things as well.
Yeah, because a mortgage payment includes your taxes, sometimes if they're escrowed, right?
That is correct.
Your insurance.
That is correct.
You can also have a public improvement district. You can have HOA fees. There's a lot of other things other than just your initial mortgage payment plus your interest. There can be 4 or 5 other categories that add into that, and it
that
can
are
add up
involved in that.
quickly.
And with that being said, in today's world that we live in and different areas that you may live in, the taxes are going to range pretty widely between one city or another city. And sometimes that city can just be divided by one street. And a percentage could be 2% versus across the street, it could be 3%. That can mean the difference of $300 or $400 a month on your house payment. So those are very important key factors. PMI is another factor. Insurance right now is one of those things where from company to company, it can range a great deal. So you really want to make sure that you're shopping insurance companies to make sure that you're getting the right coverage at the right price. So there's a lot of things that go into that, what we call PITI, P-I-T-I, which is your principal, interest, taxes, and insurance.
So tell me a little bit about the loan application. What documents do I need to get ready for you?
Well, on any standard loan application, what we're going to need is we're going to look at the last 2 years of your employment. So we're going to need W-2s or tax returns in some cases. We're going to need your last 30 days of your pay stubs. And we're going to need a couple of months of your bank statements to show assets, whatever you're using from your down payment. Some of the things that we're going to look at when you give us that documentation is that your income actually matches what you put on the application, because sometimes people get a little confused as to what they really make. So we want to make sure that that's consistent. So those types of things. Or we're going to look at your bank statement to make sure that there's not any out of the ordinary deposits that maybe you got an insurance check or maybe birthday money, or somebody gave you a gift that you didn't tell me about, that's going to cause a red flag during underwriting. So those are things that we're going to look for, and we're going to address it with you so we can get those answers before an underwriter even looks at it.
Perfect. So loan application, I can go online to your website.
That's correct.
It's very easy. I can upload my documents there, my W-2s, my income statements. And then from there, you'll give me a pre-approval letter, which is different than a pre-qual letter, right?
That is. A pre-qualification letter is basically giving me your documentation, and I can look at it and say, you know what, based on what I'm seeing here, they are going to be qualified. And I'll give you a pre-approval letter, and you'll usually present that with any offer that you're going to give. Now, sometimes another agent might be a little bit more, they want something a little bit more thorough. So they're going to want a pre-approval letter. That just means that an underwriter has actually set their eyes on it, and it's given them the blessing of that loan of saying, based on this information, we're going to go ahead and approve this, but there may be a few other things we have questions on. So that's the difference between a pre-qual, which is just an overview, and a pre-approval, which is an actual underwriter put their eyes on it and gave it an approval.
Perfect. As an agent, I feel like it's a much stronger offer that I can write for my clients if I have a pre-approval.
Absolutely is stronger. Not only is it stronger, but that means that it's already went through a little bit of the process.
Right.
So therefore the turn time on which from that point and closing can be a shorter distance, which will also help you negotiate, when you're buying a house.
Yeah, absolutely. So I know one of the big key factors is also debt to income ratio.
Yes.
Can you kind of explain what that means at the end of the day? Because a lot of these loans, like an FHA loan, you've got to have particular ratios to be able to qualify.
Yes, a debt to income ratio is your gross income minus all of your debt, installment, and revolving debt. Okay, so we take that would be what they call as a front end ratio. What's left from your gross income all the way up to sometimes a 50% of your gross income, or in an FHA, they'll be a little bit more forgiving and they'll let you go up to 55%.
55?
55% of your gross income.
55?
55.
FHA, I can have a 55% debt to
Oh,
income ratio
55%
of my payment for my house?
Well, all debt.
All debt.
So your house
that's
payment,
my
your
only
car
debt?
payment, your credit card.
Wow.
Well, they're not going to let you take the 55 all for just the house.
Okay.
They're not going to allow
But
that.
all of my debt included.
All of your debt, your car payments, your
Okay.
credit cards, all of that at 55% of the gross income. So that's how they're going to qualify you. And those are hard lines.
Okay.
So when you go through an automated system, that hard line is going to hit you at a 50% on a conventional. If it's 50.1, it's going to decline your loan. Same with FHA. So we've got to keep it within those numbers.
Good to know. All right. So it is pretty easy. All I have to do is go online, upload my documents, and then you give me a dollar amount. We can go shop for houses.
That's it. That's simple.
That's the fun part, right?
Yep. That's it.
Well, thanks. If you have any questions, reach out to us. We have all the resources that you need to be able to navigate. It is a very complicated process. And so we want to make some of the parts scary, take those and debunk them and give you the resources you need to feel very confident. Because home ownership is one of the things that really helps families feel connected to their community. The kids do better in school. There's a long list of other impacts that home ownership has on your family. So we're here to help.
We are here to help. And make sure that you call a mortgage broker versus going to your bank. A broker gives you a lot more options, or a lot more agile, be able to move through the system a lot better. Their technology seems to be a lot better as well. So always prefer to use a mortgage broker versus a mortgage banker. So that'll make the process a little bit better for you as well.
Thank you for watching.
Thank you, guys.
Share, like, save.